Hi, back again. One more section to chapter 13. I just realized as I was preparing the quiz that I had not talked about what we do, how we record sales, retirements, or exchanges, even though I explained what they were. You need to know how to account for them. So if you remember, we talked about estimating residual value and estimating service life. Said that these are estimates, and when we estimate things, we're often not 100% accurate. We try to be as accurate as possible, but we don't always hit it on the nose. Sometimes a truck might last longer than we think or less than we think, and therefore our estimates may not be accurate. And the residual value at the end of its useful life also may not be accurate. So when we sell an asset, we have to look at the amount of money that we have on the books, both for cost and accumulated depreciation, and then the amount that we're selling it for. So we need to look at book value. So if we take this truck that MMA Sportswear bought for $40,000, had an estimated residual value of $5,000 and an estimated service life of 5 years, and we sell it at the end of year 3 for whatever reason. We decide we don't need it anymore. We decide it's not the right thing for us. We need a bigger truck, a littler truck. For whatever reason, we decide to sell it. So we have to record the sale, and in this case, it will be a gain. So we're going to sell it for $22,000. So the entry we make is a debit to cash for $22,000. We have $21,000 of recorded depreciation so far. We had a $40,000 cost, a $5,000 residual value, so $35,000 depreciable amount divided by 5 years, and that's $7,000 a year. And we're selling it after 3 years, so 3 times 7 is 21. We have accumulated depreciation of $21,000. So we have to get that off the books, sitting on the books. It's got to go away. So to get rid of the depreciation, the accumulated depreciation, we're going to debit that amount. We have to get rid of the truck from the books. It's on the books at a $40,000 cost. So we have to credit the truck off the books. So now our balance sheet, the $21,000 of depreciation and the $40,000 of truck are gone, but that doesn't balance. We have $43,000 in debits, $40,000 in credits. The difference is a gain. So the book value of the asset was $40,000 minus the $21,000 accumulated depreciation. So the book value was $19,000. We sold it for $22,000, so we record a gain. If we'd sold it for $17,000, we'd record a $2,000 loss. So you have to get rid of the asset, you have to get rid of the depreciation, and then you have to record a gain or a loss. So that's a fairly simple process. In this case, we sold the asset for more than we had it on the books for. We had it on the books for $19,000, and we sold it for $22,000. So we showed a gain. In the event of retirement, when we put it out in the dooryard, the same thing happens, except in this case we sell it for $0. So retirement means we're not selling it, we're just putting it in the dumpster or in the dooryard or in the back room or whatever. We're no longer using it, so we have to get it off the books. It's no longer a useful asset, but we are going to sell it for or retire it for $0. So in this case we have a $19,000 loss. So we get rid of the depreciation, we get rid of the delivery truck, and we record a $19,000 loss. Those are both pretty straightforward. Trading is a little more difficult to understand. Here's an example of Penobscot Trucking purchasing a truck for $100,000. Management estimates that the useful life is 7 years and the residual value is $18,000. They use straight line depreciation. On the first day of year 5, which would be the same as the last day of year 4, so there would be 3 years left in the life, 5, 6, and 7. They trade the truck for a new model, which sells for $120,000. Penobscot pays the dealer $45,000 in cash and gives them their existing truck. How do we account for this? Well, this is a little different. Most people want to say, oh, well, we got a $120,000 truck, so that should be the cost of the new truck. It's not the case. First of all, we have to calculate the depreciation. So you've got 100 minus 18, 82 divided by 7. We have depreciation of 11,714 per year. 11,714 per year for 4 years is 46,857. So our accumulated depreciation on day 1 of year 5 is 46,857.16. So we have to get that off the books. We have to get the existing equipment off the books, and we have to record the cash that we're paying out. The new equipment, it goes onto the books at the book value of the old equipment plus the cash. So we don't record a gain or a loss. We record the new asset at the same price as the value of the assets we're giving up. So it's fairly simple concept, though a lot of people say, well, wait a minute, now I've got a $120,000 truck that I've only got on the books for 98. Well, the problem that accountants have with recording a gain here is, what's the $120,000? Is that the sticker price? Is it a price the dealer invented? Whatever, we purchased it for $45,000 in cash, and a truck that we had valued at 100,000 minus 46,000. So we have to record it for what we paid for it, and we paid for it with an asset that we already owned plus cash, and that's what we're going to record the new equipment at. And then this new truck, the $98,000 truck, will be depreciated over its useful life using and with a salvage value that we estimate. So we're going to estimate useful life and salvage value and depreciate the new truck over its useful life. So there is a problem on a couple of the problem like these in your homework. So hopefully you can use these this short little lecture to help you do that. No questions after this one, but the homework problems will give you some review of this. So thank you very much.